Hi, welcome back for another tax tip sponsored by Ferguson Financial Solutions. I'm Joshua Ferguson, and today I'm here to talk to you about the capital gains tax rates. So in a previous tax tip, we talked about what a capital asset is. This time, I'm here to talk about how selling a capital asset will affect your tax situation using the capital gains tax rates. Now, capital gains are classified as either short-term or long-term based on the length of time you own the asset. Now, usually when you hear somebody talk about capital gains, they're referring to long-term capital gains. And here's why. Short-term capital gains occur when you sell an asset that you owned for 1 year or less, and you sell it at a profit. Short-term capital gains are taxed at the ordinary income tax rates. Now, long-term capital gains, those occur when you sell an asset that you owned for more than 1 year, so that's 1 year and 1 day or more, and you sell that asset at a profit. Long-term capital gains are taxed at a lower rate than the ordinary income tax rate, and that rate depends on your income tax bracket. The long-term capital gains tax rates are 0, 15, and 20%. And again, they're based on your tax bracket. So for a single person making less than $41,675, their capital gains are taxed at 0%. For a single person making between $41,675 and $460,000, their capital gains are taxed at 15%. Now that's where most people fall. Most people pay 15% on their capital gains, long-term capital gains. And for a single person making more than $460,000, their long-term capital gain tax rate is 20%. Now, regardless of what long-term capital gain rate you're paying, it is lower than your ordinary income tax rate. So that's important to remember. Now, what if you have a loss? Now, capital losses are not classified as long-term or short-term. All losses from the sale of capital assets reduce any capital gains you might have and will reduce your ordinary income by an amount up to a certain limit. And then the remainder must be carried over to the next year. So for example, if you sell a capital asset at let's say a $6,000 loss, and you have a $2,000 long-term capital gain. Now that $2,000 gain is eaten up by some of that $6,000 capital loss. So now you have a $4,000 capital loss. $3,000 of that can be applied to the current year to reduce your ordinary taxable income. And then the $1,000 remainder will be carried forward to the next year. Now, there are exceptions to the holding period for long-term capital assets, such as an inheritance. An inherited property, you don't need to hold for more than a year in order for it to be considered a long-term asset. And then there are higher capital gains tax rates to certain collectibles, small business stock, and real property. I hope that helped. Thank you so much for watching. And when you're ready to sell a capital asset, please contact Ferguson Financial Solutions. We can be reached at 907-395-4027, or better yet, visit us on the web at fergusontaxpros.com. Again, thank you so much for watching, and we'll see you next week.